Hello, everyone. Welcome back. It's been a while since I covered any Fed stuff, but got a pretty important Federal Reserve meeting coming up today. We have the summary of economic projections coming out, which basically just says what the Fed is going to do for the rest of the year. And I think the Fed has done a pretty poor job at managing expectations up until this point. You saw the CPI print, or the consumer price inflation, coming in at 3.3% versus, I think, 3.4 expected and 3.4 last month. And traders are already starting to anticipate rate cuts just based on a 10 basis point drop, or 0.1%. And the CPI. Meanwhile, the Fed wants inflation to have an average of 2%. So, long way for them to go at this point. And I don't think that they're going to change their mind. I don't think the Fed is going to cut rates by the end of the year, given that they are reactionary by nature rather than proactive. So, given that, my opinion is that they won't be cutting rates by the end of the year, but other traders expect them to. Let me turn on my camera. I didn't realize that webcam wasn't on. My bad. Let's see. All right. Hello, everyone. Again, been a while since I've seen y'all, but happy to be here. If y'all have any questions for me along the way, just leave it in the live stream. I'll get to y'all. But right now, we're going to be looking at the link that I just sent that says data will be here. So you're going to look for PDF and HTML statement under June. June 12th is today's date. And this is going to give you the summary of economic projections. Again, this is just what the Fed expects for the end of year. It gives what they expect for the next 1 year, 2 years, 3 years, and I think up to 5 years. I'd have to double check. Let's see the last summary of economic projections for y'all. The last one was in March. So they do this every quarter, basically. Let me double check this is the right... That's not the right form. Yeah, projection materials is what you're looking for. Summary of economic projections for March. So you want to look at this and compare it to the new report that's about to come out. All right. So let me copy and paste the link from the live stream to the new report. That's not what I meant to do. There we go. So you're going to want to compare and contrast these two, basically. You'll see under projection materials, they'll put it right here. And then Jerome Powell will be coming in and speaking at 2:30. Welcome, everybody. Make sure to leave a vote on whether you think SPY is going to end red or green for the day, and leave a like. And we'll get this thing started. All right, data should be coming out right now. So we're going to refresh the page. It might take a minute. Oh, available immediately. So, in conjunction with the FOMC meeting held June 11th and 12th, meeting participants... they're trying to cut me out. The unemployment rate, meeting held June 11th and 12th. Meeting participants submitted their projections, employment rate, inflation in each year from 2024 to 2026. So 2-year projections. Each participant projections were based on information available at the time of the meeting. So this is just a bunch of fillers. Not really anything important there. This is where the meat is. All right, so looking at 2024, let's see, this is, I believe, end of year estimates. So they're expecting GDP to be 2.1 at the end of the year, and then 2% in 2025. 2026 are expecting 2% as well. If you're looking at the previous report, that stayed the same. Then you have the December projections 1.4, 1.8, and 1.9 versus 2.1, 2.0, and 2.0. So they expect their GDP estimates to go up for March compared to December. Unemployment rate, they're expecting at 4% by the end of the year, which this one is what really gets me, because we just saw the unemployment rate clocking in at 4% this month, and they're saying they expect it to stay the same, even though interest rates are really hitting the labor market right now. So I think that they're missing the mark on this one. My projection on unemployment rate, it's hard to really predict, but I would guess 4.2 or above. Anywhere from 4.2 to 4.5 would be my estimate. But the Fed only expects 4%, so they expect unemployment to stay the same, even with the higher interest rates that they have now. You have PCE inflation, core PCE, that's their main measurement that you want to look for, which they expect at 2.8 by the end of the year. I forget what the latest reading was. Let me see. Core PCE. Let's look at May 2024 came in. Came in at 2.8, so they're not expecting any change there. So they're basically just keeping the numbers the same, which doesn't make a lot of sense, but most of what the Fed does doesn't make sense. So, and they expect the federal funds rate to be 5.1 at the end of the year, which is what it's currently at. So they're expecting 0 rate cuts. So you're going to see bond yields going back up after dropping this morning. When yields go up, bond prices will come down. So could be a decent short on the bonds. I've got both long and short positions on bonds right now. A little bit more leveraged, I think, to the downside on bonds, if I remember correctly. And they're expecting next March. They're expecting it to cut by next March by 50 basis points from 5.1 to 4.6. And they're planning to keep the federal funds rate at 3.1% at least until 2026. So we're not going to go back to 0 interest rates like we had before, supposedly. Now, the Fed can be wrong. They did the same thing back in 2018, and then the Fed pivoted because the stock market started going down. So if Jerome Powell is still in the driver's seat, I would expect nothing less. So that's your median. You have the central tendency, and then you have the range. So you're going to look at the data points here. The highest expectations for unemployment rate looks to be about 4.5 to like 4.75. I think that might be a little bit too high, but I wouldn't be surprised on that estimate being correct. Then the interquartile range is like 4% ish. Very small interquartile range. And they expect unemployment to slowly decline in 2025 and 2026. PCE inflation, pretty tight range between, looks about 2.25% and 3%. I really wish they had like more accurate markings. instead of being so distant. But PCE range is actually pretty decent, down from 2.5 or 2.75 all the way up to like 3.5. I could see inflation sticking around. My bet really is on stagflation, given what the Federal Reserve is doing right now. It doesn't make a lot of sense to put our economy through this continuous stagflation because you're getting higher prices and unemployment. To me, I would rather rip the Band-Aid off if I were the Federal Reserve, which fat chance of that being some young, dumb 28-year-old. And then this is your dot plot, midpoint of the range with a federal funds rate. So majority came in at between 5 and 5.25. Actually, no, majority came in at below 5. And this is for end of 2024. So you actually might have, maybe you have rate cuts by the end of the year, but central tendency is going to be 5.1, it's looking like. So, and then you have a wide dispersion. The further out you go, well, I guess for 2025 and 2026, long term, you're a little bit more consolidated. But 2025, there's a lot of contention there. There's some Fed members that think we're going to drop all the way down to There's one Fed member, I should say, thinking we're going to drop all the way down to 2.8. And then you have, I think this is probably Fed Kashgar, I'm not sure, up at 5.4. So they're expecting to keep rates at the same, basically, until the end of next year. But most people are saying cutting all the way down to 4.25-ish for 2025. But notice how none of these rates are anywhere close to zero, which is at the bottom, right? So the Fed's putting on the show of, we're not going to cut rates, we're going to stay in this non-zero interest rate policy. But they did the same thing again back in 2018, so we'll see. Let me pull up some stocks. Let me cut my screen off right quick while I log into my Thinkorswim. Anybody else affected by the Schwab shutdown yesterday? Just a slight glitch in the stock market. Let's see. Okay. All right. Should be getting into the trading account now. So my account, I think, is down about 1% on the day. It's actually climbing a little bit after the FOMC release just came out. Let me see if I can... I swear I logged into Thinkorswim, but I logged me into Schwab. Thinkorswim is a lot better of a platform than Schwab has, which is probably why they ended up buying it out. Okay. Had issues with the Schwab, yeah. It's pretty rough, man. Basically everybody couldn't log in from what I heard on Twitter, at least. Okay. I can turn my screen on now. You'll see my portfolio in action. make it a little bit bigger here. All right, so these are all the positions that I have currently. Back holding on UVIXI, so there's going to be some volatility that I'm expecting, I think in September for the Democratic National Committee. It's a bit of a far-fetched theory, but seems like they might be replacing Biden as the candidate just because he's losing in the polls. And yeah, that report coming out recently about his cognitive decline. I'm kind of behind Jason on Twitter in thinking that they're going to do a hot swap is what Jason is calling it. But yeah, let me get rid of this. Kind of talked about all the data points. Not to say that I'm for or against Biden. I don't care about either of the politicians that we have. If I buy options of further out, is the return greater? Yes. It can be. But you have to have the right psychology behind trading. My screen's extremely zoomed in. My bad. Yeah, OBS does that by default for whatever reason. Thanks for catching that. Okay. So, these are all the individual positions that I have. Currently long on Aurora, which is a autonomous driving company. I've been divesting out of Tesla recently to buy into that just because I don't like what Elon is doing right now. I think that he's kind of steering the company in the wrong direction, but it is what it is. Currently down 6,000 for the year, so probably because of my UVIXI position mostly, and then being long on small caps with Fulgent has really weighed down in the portfolio. But I think there's going to be a reversion away from big tech and into small cap stocks at some point, probably over the next 2 years. And that's really the timeline that I invest on is, I'm looking for the next 2-year return, next 5-year return, even sometimes like decades out. So I don't really care about the short term. I do care about the short term when it comes to like volatility, like being long on UVIXI for the potential of them swapping out Biden in September. There's some short-term trades that I make, but I try to keep that to a small percentage of my portfolio. But you can see most of my losses right now are from that UVIXI position down 3,300. I'm not sure how much UVIXI would really go up in that case if they swapped out the Democratic candidate, but we'll see. Let me check PL by day, see what's doing the worst. So this position up top, SJB, this is a liquidity problem more than anything. It's not technically this $235 loss. So if you're going to trade derivatives on things that are kind of unusual, SJB is a good example. It's a short high yield bond ETF. You will pay the price of liquidity, right? Which means that the bid and the ask are going to be a lot wider, and especially if you're going to buy call options, it gets really messy. Let me see if I can find the bid ask on this chain, actually. Yeah, I'm not even... Sorry, I'm just not used to using this platform. Here we go. Yeah, so your bid is 0 and your ask is 25. So there's nobody buying this thing, which is why I'm getting weighed down by this position right now. Is the FOMC going to start? Yes, they will start at 2:30. Jerome Powell speak. Another question. Does higher delta mean greater return on an option that's a week out? Yes, but a smaller percentage usually. So if you buy an out of the money option, you're going to get a lower delta. But if that option does end up going well, the payoff is usually larger in percentage terms. Whereas if you have a high delta option that's already in the money, you have a better guarantee of a return. It's not total guarantee of a return, but it's less risky per se. And the more risk you take on, the more reward that you expect to get. A lot of the options that I trade is out of the money contracts just because they're cheaper and I'm looking for very high payouts, right? I don't trade with a lot of my account. Personally, with options trading at this point, I only use maybe like 2% of my account for options trading. I used to be very aggressive and use like 20% of my account, which is why I kept blowing it up. But now that I've decreased it down to like 2%, I haven't seen nearly the kind of volatility that I usually do. So my strategy is basically picking options that are super far out of the money, only putting down a small amount to them, and then just seeing if it pays off. Like right now, I have an NVIDIA. Blue Sky just brought up NVIDIA. I have an NVIDIA put that I paid $800 for. And in terms of my total account, that makes up... that makes up like 1.3% of my net worth, so it's not a ton. Still a little bit too aggressive, but that's just because NVIDIA options are ridiculously expensive. So that's the price you got to pay for irrational exuberance. Have I done a video comparing Intel to NVIDIA, though? That I have not. NVIDIA, I would say that they're very good at taking advantage of new cycles. I think that Jensen Huang is brilliant at taking advantage of the newest, hottest thing. It started with gaming, then he moved on to AI recently, and there's other industries that he's kind of toyed around, like cryptocurrency. He's very good at picking the right opportunities and kind of getting people behind the technologies that he's investing in. There's no doubt in my mind that he is a great marketer. The only doubt that I have is whether artificial intelligence will maintain its current value. AI, in my opinion, right now is very similar to the dot-com bubble. I was too young to remember the dot-com bubble. I've just done a lot of talking with people who did invest in the dot-com bubble and just a little bit of studying myself. But basically, the dot-com bubble pulled forward valuations like decades ahead. And in my opinion, I think that artificial intelligence right now isn't where people think it should be. So people think that artificial intelligence is going to replace us. I think 20, 30 years down the line, yes, there's a chance that it can replace us. No doubt about that. But if you're talking about the next 10, 15, 20 years, I think it's just going to act as a assistant to human intelligence, all right? Like I use it for some of my research that I do in private equity, and then some of the research that I do for these public stocks. But I still have to form my opinion on the research that it's doing. I have to put in the trades, or I have to advise my boss, like, is this a good investment or not? I still have to do that work. Now, it can pull a lot of information. One of the best research tools that I found is Grok by Twitter. Whether you agree with his politics or not, Elon is pretty good with that LLM. Gemini has gotten a lot dumber since it first came out. The only reason I use Gemini right now is for my YouTube channel and search engine optimization for my videos. It's very good at that. But like there's specific use cases for each individual tool. and it's not broadly applicable yet. You don't have a generalized AI solution, and I don't think that we're going to have a generalized AI solution for probably the next 10 or 20 years. So again, my opinion on AI right now, valuations are pulled a little bit too forward, similar to how they were in the dot-com bubble, but we'll see how it all plays out. I think that there's been a lot of investment into AI over the past couple of years, and I see the merit in it like 20, 30 years down the line, but I just don't see the merit in it short term. So many stocks just spiked down about 10 minutes ago. Yeah. Well, the whole stock market was super bullish this morning because we got a CPI print that came in 0.1% lower than it did last month. And it's just, there's too much speculation in the market. I say this as a speculator myself, but like there's just too much irrational exuberance, basically. Yeah. Anyway, so let's see what positions I want to take on possibly for today's meeting. Let me see what SPY is up to on the chart. So let's see what y'all are saying in the chat. 69% are saying green for the day for SPY. Let's see how much it's up right now. It's already up by 1%. With these Fed meetings, they can have a variance from what I've seen of about like 1.5%. So it would take a lot in order to get that into the red, but I wouldn't be completely surprised by it. Right now, though, you're seeing a huge concentration into mega cap stocks, Nvidia especially, Tesla, all the big tech names. I think Apple just hit a new all-time high, actually, after their AI announcement with, who was it? OpenAI. It's trading at 218. Jesus Christ. Yeah. And I just think that these valuations are getting a little bit hairy, but we'll see. How many contracts do I have on average? Just one usually, just because how expensive the contracts on Apple and Nvidia and the stocks that I trade are. If it is a smaller stock, let's say Fifth Third Bank is one that I'm shorting right now. This is a loss trade. I already basically lost all the capital I put into it, but this one I had 5 options into it, and it's only like a $30 stock. So it really depends on what the stock price is, and that'll determine how much I put in. But Nvidia, like that one cost me like $800 today or yesterday. Citizens Financial, I think this is an option that's expiring in December that I paid $370 for, actually. That's a decent chunk of change for a $35 stock. I wouldn't have expected that. But yeah, that Nvidia trade, that one got pretty expensive. And then I'm short on CBRE, which is a commercial real estate company that has a bunch of empty properties up in the Northeast right now. So these are longer term plays. I mean, you're looking at 6-month trades. Usually is what I play, just to buy myself enough time in order for the thesis to play out. I don't usually play short-term options just because they're almost always going to lose you money from what I've seen. I've tried day trading in the past. Didn't really work out for me. I had probably less than a 50% win rate on it and just kept losing money out of my ass. But if you extend your expiration dates and you bet basically the inverse of what people are expecting, like for me, expecting banks to be failing over the next 6 odd months or so because the Fed is mishandling the economy, there's a lot bigger of a payout that you'll get out of that and putting money into that than you will get out of like a weekly option. Eli Lilly, I think, if I remember right, Eli Lilly, were they the ones that were... I'm not big on medicine, but let me see. Were they the ones that were making Ozempic or whatever? Yeah, they have a new obesity drug. I mean, yeah, there's probably a lot of people that'll buy it. I just have I'm a little bit jaded towards the pharmaceutical market. I think that there's a lot of weird stuff that goes on. But yeah, Apple just hit a new high, 219. That OpenAI stuff's really boosting them. All right, so Jay Powell's about to speak in 4 minutes, it looks like, so I'll shut my mouth in about 2-3 minutes or so. But if y'all have any questions, you can just type them in the chat, and I'll type back to y'all. I'm still long on Google right now. Google, I'm thinking about taking profits on just because the AI hype is a little bit much, and I think that Apple and Google are basically teaming together. Apple and Microsoft. So Microsoft owns OpenAI now, and this new venture that they're doing between OpenAI and Apple is basically a dig at Google, because you have two $3 trillion companies going against, I think Google's a $2 trillion company. So they have a lot more funding than Google. Google has all the data, which is good. I mean, with YouTube, with Google, they basically own the internet's data. But at the same time, you have two $3 trillion companies versus a $2 trillion company. It's going to get pretty hard for them. Honestly, I've been thinking about putting money into Apple, but after this AI stuff, I'm kind of avoiding it right now. Although Siri definitely needs an update, so I'm glad that they're finally getting around to it. Where am I watching Powell speak? You can watch him. This is the link for it. It's on the Federal Reserve's YouTube channel. They actually have their own YouTube channel, which is pretty cool. Can't sell. Apple calls up 700. Jesus. Is there no liquidity on the option? Okay, here we go. Let me just send a link to my Discord channel. That Powell's about to be speaking. And I'll cut my mic so y'all can just listen to him. That's the wrong link. My bad. Okay. Alright. Here we go. Let's see how this plays out.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really, and we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that, I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I don't really, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible. But I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that, and some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that. So that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
John Allen. Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, you know, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and you know that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, you know, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, I mean, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, you know, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Gina Smiler, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately, we think that things like the neutral rate are driven by longer-run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking. And that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had, above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. Look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Mike.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. to some extent, that's catch-up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction, but one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth, or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria. Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just tell we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Urbanovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's the whole. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Kosuke.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't, actually it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has been, has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once, you're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation?
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one thing, one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, you know, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And, you know, and of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
All right. Well, that was an interesting one. Let me make my screen. We'll go to the trading screen, actually. So basically what I got out of the meeting is that they can't really trust the data that they're getting. I don't know if y'all caught on to that point, but he was saying there's so much incoming data for them to look at, they're not sure what would be the right measure. And somebody in the chat here, Brett from LA, asked, what is the Fed's definition of a strong economy and what are the actual indicators? So the Fed looks at a lot of different indicators. You have forward-looking indicators, you have current indicators, and then you have backward-looking. So unemployment is a backward-looking indicator. If people are losing their jobs, it's already too late. But that is the main thing that they're looking at, is the unemployment rate, which they expect to be the same at the end of the year that it is right now. So they expect unemployment to be at 4% by the end of the year when it's already there. And one of the journalists, or I think a couple of the journalists, kind of touched on this point, is why do you expect to cut rates next year if you expect unemployment to be the same, which I thought was a really good question. To me, it didn't seem like he gave a real answer to it, but the second measure that the Fed is looking at is the unemployment, and then you have core PCE, which is their favorite measure of inflation. Core PCE excludes energy and I believe housing, which are two of the biggest components. Shelter, which are two of the biggest components to the average everyday budget, right? Your biggest expenses are usually going to be your house, transportation, and food. So they kind of pick and choose what best fits their narrative. I mean, if you look at housing and how much that's gone up over the past 10 years, it's well above the 2% inflation rate. And over the last few years especially, it's been well above the 9% inflation that we saw last year, the 3% inflation that we saw this year. And that's the biggest expense for most people, is the roof over their head. So good thing is, if you're living in a major city, we are seeing rent prices come down. I was listening to a person on TikTok talking about the Austin market, to where they were charging something along the lines of like $3,000 a month for a one-bedroom. We have some Pittsburgh places that charge the same rate. But then there were, I guess, big banks that were coming in that were willing to take the loss for a couple of years or so, that are undercutting them at like $1,100 for that same build, basically, of a one bedroom. So we're seeing a lot of cooling in the rental market. And I've even seen it personally, rents starting to come down a bit. Not where I'm living, because I live in a decently cheap place that I think will continue to be reasonably priced. But it's something that landlords have started implementing last couple of years, especially the big ones, is they'll give you like a 1 month discount basically for the year if you sign a 12-month or 13-month lease or more. But recently this year, I saw they were doing 2-month discounts. So if you're paying, say, $3,000 for rent, you divide that by 12 for a 12-month lease, you're getting a $250 reduction from $3,000 down to $2,750. So you've seen a little bit of deflation in rents there, but I think that we're probably going to see significant deflation in rent just because I think home prices are bound to come down because of the high interest rates that we're continuously experiencing. I think that it's inevitable over the next few years that housing prices will come down because everybody thought that we would go back to 0% interest rates. You would be able to get a home loan for 3.5% interest like we did back in the pandemic days, and I don't think that it's possible to get back to that level. But Jan's asked, are we in a bubble? So in my opinion, I think that the biggest bubble in the market right now is artificial intelligence. You mentioned artificial intelligence in a press release. Your company, your stock goes to all-time highs. Apple is a perfect example of that. Oracle is a good example of that happened today. And pretty much anybody that's mentioning AI in either their earnings releases or, looking into partnering with OpenAI, their stocks are going up double digits in percentages. To me, that's telltale signs of a bubble, and you don't know how long bubbles are going to last. That's the biggest problem, is the timing on it is very difficult. And right now I'm kind of losing my ass betting against NVIDIA, which is up 3% today, and they're one of the biggest beneficiaries of AI. Right? They're the ones that are supplying all the chips. They're the ones that are providing the pickaxes for the supposed gold. In my opinion, the gold is actually sterling silver that's wrapped in gold, but just a personal opinion. So much investing into AI. Yeah, exactly. And I think that there are industries that we can invest in that are adjacent to AI. In my opinion, I think robotics is a much better place to be. I don't think that it's as overvalued as AI stocks. I'm personally looking into augmented reality. I think is probably going to be very popular over the next 10 years. If Mark Zuckerberg is investing all of this money into the metaverse, he's not doing it for nothing. He expects a return, a pretty decent one. So, in my opinion, there are other industries that you can invest in today that are probably going to perform artificial intelligence over the next 10 years, just because of how overinflated artificial intelligence stocks have gotten to this point. So, that's my opinion on the bubble, or potential of it. If y'all have any questions, just leave it in the chat, and I will see if I can find any trades for the day. So, like I said, I'm bullish on robotics. I have 12 shares of BOTZ, B-O-T-Z, which is a ETF. And I was actually thinking about adding a couple of positions maybe today. So one of the positions I want to possibly invest in would be Qualcomm. So Qualcomm is another chip maker stock, and there is a little bit of risk because chip maker stocks are pretty expensive right now, but Qualcomm, they are more geared towards augmented reality, whereas in my opinion, at least NVIDIA, it doesn't seem like they care about augmented reality as much. They're more focused on crypto mining and artificial intelligence, when I think AR is going to be the next venture. So Qualcomm would be a decent position to add, in my opinion. It's up like 2% today, which can be a little bit high, but if you don't buy a ton, what I like to do personally is wait for a red day in the market. So buying yesterday would have been better after the huge red day that they saw. Getting in at 206 instead of 213 would have been much better, but this is one stock that I'm looking into. And another one that I saw was Himax, which I invested in before. I think I ended up losing money on it. I bought it when it was trading at like $10, and now it's trading at $6. But I'm really interested in small caps right now, because I feel like there's probably going to be crackdowns on the big monopolies, Apple, Microsoft, Google. It happens every once in a while to where the government finally does something about it, or says they're going to do something about it. It usually never gets done, but I think at some point there's got to be a way that we break up the monopolies and try to support small businesses, because that's really the bedrock of our economy. It's not Amazon or Nvidia and stuff like that. But yeah, I'm going to purchase shares of Qualcomm for now. I'm probably just going to start off with a small position on one of them. Let me make sure I don't buy 100 of them. That's the default on Thinkorswim, so be careful with it. So I'm going to buy one share on that. And then I also want to buy into an equal amount into Himax, if I can find the stock. So it's trading at 7 at the moment, 200. I think that was 213 over 7. So I'll buy 30 shares on this. And this is a position that I'll add over time, just because I think that it's a decent opportunity. This one had a bit of a breakout. If you're looking at technical analysis, I'm not really a big technical analysis nerd. Never have been a big fan of the charts, but all right. Got those two trades in. Let me make sure that so if you're not part of the Discord, it's the pinned comment. So you'll see every trade that I make in real time. And then I always post buy to open. Or if it's a sell to close, I'll post that too. That's weird. So the order for Qualcomm got submitted but didn't go through. I wonder if it was a limit order. That's so strange. Aurora's up like 5% today, which is pretty nice to see. That's so weird. Notifications. Triggered. These are my alerts. I'm not used to the online platform. It's kind of a pain in the ass. There we go. Got filled at. Yeah, so default is a limit order on Thinkorswim. Should have been a market order, but that's okay. But Yeah, if y'all have any more questions for me, just leave them in the chat. I'll be happy to answer. But those are probably going to be my 2 trades for the day. Looks like y'all were right. 76% said SPY would end green of the day. And what is it? It's up 1.1% or so. But you're seeing a high concentration right now. A very high concentration into the mega caps, which is my biggest concern. If you look at the equal weighted S&P 500, that's where it gets kind of hairy, and why I think we could be in a bubble. Part of the reason why we could be in a bubble. So let's look at equal weighted S&P 500. We're going to start a Q&A. Never done this one before. By equal weighted S&P 500, if you're looking, the year to date is up 4.6%. Over the past year, it's up 13%. Where if you look at just a regular S&P 500, that is, let's see, up 25%, so nearly double, and up 14%. So that's where my biggest concern is all of this concentration into the top names. And we've seen this phenomenon last year. I think in 2023, there was a huge concentration into the Mag 7. And you're continuing to see that right now with all this talk on artificial intelligence and people buying into any mega cap name that even mentions artificial intelligence. And to me, that seems like the telltale signs of a bubble, but I could be wrong. Time will tell. How long can banks survive in the interest rate environment, especially with credit card defaults rising? So here's the thing when it comes to the banks. If their balance sheets are decent, then they can survive. What the Federal Reserve did whenever they implemented the program after Silicon Valley Bank collapsed, I forget the name of it at the moment, but they allowed companies to basically shift their balance sheets. From what I heard from the uneducated economist, he was saying that basically their assets fell by 30%, but the Fed was giving them a credit line to say, hey, your assets might have fallen 30%, but we'll pay you the full amount for that. So they extended a credit line to them. Another part of that deal was that they allowed for banks to get a 100 basis point discount on the federal funds rate, which gave them a lot of liquidity, basically. If you can get rates 1% cheaper and, charge people the same amount because the federal funds rate didn't drop, then they have more margins that way. But the problem is that BTFP, Bank Term Funding Program, after Silicon Valley Bank collapsed, that ended in March. So, in my opinion, I think that banks will probably see some pain towards the end of the year. I have a vested interest in this, obviously, because I am short banks, especially CBRE is my biggest short position. So I'm short CBRE, CFG, and Fifth Third Bank. Fifth Third Bank, I think I already lost all the money that I put in. This option's expiring like next week, so that's a burnt trade. But I'm still short on CBRE, which is a commercial real estate group up in the Northeast. They have a bunch of empty properties here in Pittsburgh. And then even in DC, when I was there a few weeks ago, They had an empty a pretty decently sized empty property there. So I think there's going to be a lot of pain, mostly in commercial real estate. I don't know if the pain is going to be felt from credit card defaults yet. He did mention something about credit card default rates not being as elevated as they were back in the '08 crisis. I want to look at the data, though, on that, because I don't believe it. So this is a delinquency rate on credit card loans, which is what he was talking about. All right, so I'll link the... Can I link this? No. That's so weird. Let me see if I can link it on my iPhone. Gotta love iPhones in the copy-paste system. All right, so this is the data that I'm looking at right now. Delinquency rate on credit card loans is almost at the same place that it was. Let's see, it's currently at 3.16. The lowest that it was before the '08 crisis was 3.54. So it's climbing, kind of tapering off recently. But definitely on the climb. So if we see this starting to go closer to 4 or 5, maybe we see some pain there. But I think there's actually something else we can talk about when it comes to credit card delinquencies. I'm sure that a lot of y'all have heard of the buy now, pay later stuff, like Klarna. There's a couple other places that did it. Even Apple got into the buy now, pay later. And a lot of those loans are starting to default because there's no ramifications for it, right? It's a soft credit check to where it's not going to impact your credit. So people can basically borrow as much as they want from these BNPLs and not face the consequences of not paying back. So I think that's why you're seeing credit card delinquency rates as low as they are compared to, 2006 to 2008 and up until 2009. That would be my assessment of them. But obviously I could be wrong. Just a thought. Oh, I didn't link the dang data. But yeah. So credit card delinquencies are going up, but you have that buy now, pay later stuff. And if you are in a bunch of credit card debt right now, one thing that I would probably recommend, go to a credit union in your neighborhood, and they will give you really good interest rates for a personal loan. If you go to any of these online places, they're going to give you like 25% interest. But if you go to a local credit union, they'll usually cut that by like 60%. I just went to my the credit union that's in my neighborhood, and they're giving 8% personal loans to anybody with above a 650 credit score. So there's alternatives out there. If you're under a bunch of credit card debt, I would definitely look into that. So we got Qualcomm added to our portfolio. I should probably start exiting some of my other positions because I have way too many at this point. I try to consolidate my portfolio into like 10 positions, but at this point it's kind of overbloated with a bunch of different random stuff. I kind of want to sell out of my UVXC. I'm already at like a $3,300 loss just because of how much I invested so early. Let's see, I have 15 shares and it's trading at 23. So there's only like $350 in that position that I could use it elsewhere. I really think the volatility though is going to come around the election. Somebody talked about this earlier in how they're trying to prop up the stock market before the election, which I think is probably the case. They want to make the current president look as good as they can on paper, right? As long as the stock market's doing well, at least he'll get the vote from the people that are invested. But at least from what I've been seeing, and this is a pretty far-fetched theory, but Jason Calacanis on Twitter has been talking about a hot swap, to where they're going to basically swap out Biden with a new person, basically. So could be Kamala Harris, could be Michelle Obama. There's a bunch of different prospective people nobody knows yet. But after the report came out on his cognitive decline last week from the Wall Street Journal, I think that's kind of what they're trying to push towards. They have the Democratic National Committee, I think in September, if I remember right. And that's where they get the chance, basically, to swap out the current president. No, I don't like to get political, just because I don't like either of the candidates. I think that both Biden and Trump, we shouldn't be picking between the better of two evils. I think that America deserves a lot better. But no, not a new body double. I think that they're going to replace him with somebody like Michelle Obama. I don't think Kamala Harris is going to get it because her approval rating's like 20% or 30%, something super low, even lower than Biden's. And I don't know, like, people have been speculating Newsom, but I think that California is a little bit too far left for the general population to get behind. You need a neutral. You need somebody that's in the middle, a middle Democrat, which right now seems pretty hard to find. Yeah, I kind of think it's going to be Michelle. I think Michelle Obama has a good chance just because of the nostalgia factor during the Obama era and the beginning of it. I think she has a decent chance, and she was pretty big on the education front, which I think our current system is failing us in the education system. So she could be a decent candidate. I don't know who else would be it. We'll see. But the whole point of this political rant is it's going to cause a lot of political volatility. So if all of a sudden the Democrats decide that, hey, we're going to switch it up, we're going to go with Michelle Obama or Gavin Newsom or whoever they decide on, if they decide to swap out the president with one of these new people, it creates a lot of uncertainty of what's to come next. Because you had two choices, and now you have this new random variable, basically, that's going to increase interest rates for the United States. It's going to end up dropping the stock market because of political volatility, and I think it would be very detrimental for the economy if they decide to do it. And to me, it's kind of looking like they're pushing more and more towards that. But yeah, I think it's September, Democratic National Convention, not committee, I'm sorry, is in August. So 2 months away, August 19th through the 22nd. And that's where they get to make the decision on swapping out the president. So we'll see. Hopefully they give us I pray that they give us a decent neutral candidate, because these two clowns, we can't continue to have them. But yeah. Let's see. Nvidia is still up 3.3%. My position's down 75. I wish I could add to the position, but it's just so damn expensive. You could always do spread options, but I don't think that I have level 3 options on this account. I could probably switch to a different broker and get it, but I've been too lazy on that front. Bots, BOTZ stock is up. So again, this is one that I like. If you want to invest in new technologies, I would say robotics is probably going to be a major factor, and I think augmented reality are going to be a major factor. So let me see if I can find any augmented reality ETFs. So there's no big ones yet. Like, you don't have the people that made SPY, Global X. You don't have those in yet. But let's see, Blue Star, augmented and virtual reality. Ticker symbol V. Oh, VGTs. That's Vanguard Information Technology. That's not specific enough for me. Let me see if I can. I swear that I saw Blue Star Augmented and Virtual Reality Index Tracker. I guess there is no AR ETFs. Maybe I'm wrong. Verse, VERS. Enter the metaverse with a single ETF. So this one could be a decent play, and this is ProShares, so they're actually pretty popular. VERS though. Verse. Metaverse ETF. So Metaverse I'm less bullish on. I'm more bullish on augmented reality. But this is the yearly chart on a weekly basis, and it's pretty flat. Like, nobody is buying into this yet. If we look at the past, like 5 years, this actually only dates back to March of 2022. I want to see what's in the holdings, though. Obviously, like, you want to see what they're investing in and not just go into it blindly. VERS Metaverse ETF. Fund details. Yeah, so if you invested 10,000, you would have 11,000 right now. So it's not up a ton over the past couple of years since inception. Expense ratio is 0.6%, which is kind of high, but so that's what I don't like. They're heavily invested in Nvidia at 5% weighting. Apple I could see. So these are the stocks that I would probably want to look into for augmented reality. Apple, Meta for the mega cap companies. Amazon I'm not too sure of. I don't know if I would invest in Amazon for augmented reality. Himax, that one, that's interesting that they have such a high weighting actually. 4.3%. So they're betting pretty big on this small cap company. That's kind of nice to see as an investor in it. Microsoft Corporation, Roblox, that actually might not be a bad one. Roblox has kind of kept their relevance, surprisingly, given how old the game is at this point. Fubo TV, and then Vuzix. I've heard of Vuzix, but haven't invested in them yet. But basically, you can kind of mimic these portfolios, pick and choose which ones you think will do well. So in my opinion, Apple, they're very good at pivoting into the new biggest sectors. So Apple I could see doing well. Only problem with Apple and augmented reality is that the entry price is way too high. If I'm paying $3,500 for a pair of goggles, they better be the best damn pair of goggles I've had in my life. Which Apple has a tendency to do that, but if you look at the naming on the product, it was what was it, Vision Pro or whatever. So it's a Pro series, which means that they're probably going to have a cheaper version later on. And if they can compete with Meta, who offers a $300 pair of augmented reality goggles, then they stand a chance in the AR space. Himax is a chip-making company based in Taiwan. So you do have that risk of, the war with Taiwan and China, if that ever comes to fruition. But this stock is a chip maker. It is already up quite a bit, 40% over the past couple of months, which does kind of ring some alarms for me. But this company has a lot of cash. I was just looking at their balance sheets yesterday. They still had probably a year or two worth of cash left. I'd have to double check it, but yeah, it's a Taiwan semiconductor maker. Do I have suggestions on semiconductor companies in case China invades Taiwan? Buy puts. If you perceive that risk to be high, you can always hedge your bets by buying puts on the stocks that you own that would have exposure to that risk. So right now I have 30 shares of Himax, but let's say that I think there's this chance that maybe 12 months, 18 months down the road, China could invade Taiwan. What I would do personally, go to Himax, go to their options chain. Let me see if I can find the options chain first. There we go. Choose the higher end of that time frame. So I said 18 months, which would be 191 days, or I could even go with a 219-day expiration. So December of 2024 or January of 2025, I would probably go January 25. And then I would want to find a delta that's almost equivalent to the 30 shares that I have. So I am long delta right now of 30 because I have 30 shares. So for every $1 that Himax goes up, I make $30. So if I perceive the risk of China invading Taiwan to be high, I want to bring my delta down to break even, basically. So what I would do is buy this negative 26 delta put option. So it's only going to cost me $45, and this is basically protecting me in case that risk does come to fruition. And let's say Himax drops, I don't know, 30%, right? It's trading at $7. You multiply that by 70%, it would drop all the way down to $4.90. So now my $6 put option with a negative 26 delta goes from 45 cents to 110. So that would mitigate that risk for me. So there's ways that you can kind of manage your portfolio to account for those tail end risks. And this is what I've been using options for recently, is kind of managing those tail risks. So for me, the biggest bets that I'm making is on the banking industry collapsing. I'm still long on bonds right now. I also have short bond positions. I have a mixture of everything right now. My portfolio is a little bit bloated, but yeah, if you want to mitigate your risk, that's the way to do it. Yeah, you can do a put debit spread too. That's one way. Is Boston Dynamics affiliated with a stock or ETF? No, they're still a private company. So I really wish that they would go public, but I think that they want to keep it private. That way they have control of what they do. But bell just rang, so I'm going to head off for the day. Thanks for all the questions y'all had, and thanks for tuning in. And maybe I'll catch y'all for the next FOMC meeting. Let's see when it is. FOMC calendar. I think it's in September. Yeah. Now July 30th, 31st, and then September 18th and 17th. So, yeah, I'll be seeing y'all then. Probably going to have some debates on the channel in the coming weeks. I have one scheduled for this weekend. Hopefully it doesn't fall through. Talking about cryptocurrency. I've been pretty long on cryptocurrency lately, adding to my positions. Let's see. I mean, I can show y'all my ledger. Looks like crypto's falling right now after the FOMC meeting concluded. But I'm long crypto for like the next 3 cycles till like 12 years down the line. But current crypto portfolio is 11,776. I got 1.2 Ethereum. I've got 22,500 Doge, and then 0.05 Bitcoin. And then I'm still working on transferring money from my Coinbase over to the ledger, just in case, shit hits the fan and you see Coinbase going down or whatever, just like Sam Bankman-Fried and the collapse that we had a couple years ago. I'm trying to avoid that the best that I can, and the best way to do that is just by having it on a ledger instead of on these trading platforms. So anyway, that's all I got for y'all, and I'll catch y'all in the next one. See you guys.